Welcome everybody to the 22nd Business Insight episode on the 12th of October 2020. Business Insights is a very exciting webinar series hosted weekly on Mondays by a panel of industry thought leaders for business owners who simply want to be in the know about the latest and most significant news and initiatives in the Australian business landscape and how that impacts how you do business. Our panel of advisors aim to inform, educate and provide strategic insights to changes in the economic, legislative and financial landscape that affects small business. We aim to guide our viewers to navigate business challenges through COVID-19 and beyond. So let's now meet our panel of industry thought leaders. First off, we have Mr. Adam Light.
Yeah, hi Sam, thanks for having us and a lovely afternoon in Sydney.
Yeah, great to have you on board. Next we go to Ian McLaughlin from Imperium Accounting.
Hi Sam, thanks very much for having me.
Lisa Greedo from Enigma HR. Hello.
Hi everybody. Sorry, I so missed you guys last Monday.
And Rob Scheme from Oasis Scheme Property Buyers. Hello, Rob.
Hi Sam, hi panelists, hi viewers. Great to be back after 2 weeks. Big thank you to Susan Barker from Carlo Property for filling in for me over the last couple of weeks.
Indeed, thank you. And Bernie, our insurance specialist, is on a well-deserved break this week. So we'll have him back on board next week. And my name is Sam Gracie from Atlantic Private Wealth. I should also provide this final general warning to you. The views and opinions shared on this webinar are designed to be general information only and are not designed to be taken as specific advice for your personal or specific circumstances. Please feel free to reach out to any of the panel members for your specific advice to meet any specific requirements that you have. With that, let's just get started. And obviously the biggest news of last week was the budget. And so let's throw it to Ian to get a bit of an update on that, please.
Thanks very much, Sam. So what I thought I'd do today is just give a brief summary of the overall tax changes that came out in the budget. And then in the following weeks, we're going to be looking at some of these in more detail. So let's start off with the personal income tax measures that were introduced. So the following tax cuts will take place effective from the 1st of July 2020. So backdating those changes a couple of months. So the threshold from the 19% personal income tax bracket will increase from $37,000 to $45,000. The low income tax offset will increase from $445 to $770. And the 32.5% income tax bracket will increase from $90,000 to $120,000. So there's a lot of room to move there in that last piece there for business owners that generally just pay themselves a salary of $90,000. So let's look at some of the business tax incentives that were introduced. So from 7:30 p.m. on the 6th of October 2020 until 30 June 2022, businesses with an aggregated annual turnover of up to $5 billion will be able to deduct the full cost of eligible depreciable assets in full. So that's a huge one. So basically, prior to that, we had this $150,000 asset write-off. Well, that's basically just been blown out the water, and they've just lifted it to entities with a turnover up to $5 billion and assets at any cost. So this one here I'm going to touch on now, but I'm going to go into it further next week because there's a bit what I want to cover off on it. But it's basically the temporary loss carried back to support cash flow. So the government will allow companies with an aggregated turnover of $5 billion or less to offset tax losses against previous profits on which tax has been paid to generate a refund. So eligible companies can carry back losses from the 2019/20, 21 and 22 income years to offset previously taxed profits in years from the 2019 year and then onwards as well. So they've also increased the small business entity turnover threshold from $10 million to $50 million. So next week, we're going to look at how that interrelates with the other measures as well. There's also the job maker hiring credit, which I know Lisa is going to touch on a little bit further. And then there's also some changes to FBT and the R&D tax initiative as well, which we're going to touch on in more detail next week. So that's basically it from me today. Just wanted to give a brief overview of the major changes to do with the tax measures that are introduced in the budget. And then let's next week delve deeper into those and see what they mean and how businesses can take advantage of them. So thanks very much, Sam.
Fantastic. Thank you very much, Ian. A nice short summary. I look forward to expanding on those in the coming weeks. Let's go to Adam Lyle now, the Biz Doctor, and just get some update as to what's happening from his perspective.
Yeah, so it goes along the same lines as Ian, but overall, if you could be really forgiven for watching the budget this week and opening up a packet of Tim Tams and grabbing out the Earl Grey. It was nothing special. I usually get really excited about budget night. I have a party, you know, I break out the mint slices even. It's a rarity in my household, and this year it was not much there. It was really benign. Why? Why was it really benign when we've fiscally invested 45 times the amount of money that we did in the GFC? Well, I'll just say that number again. 45 times the amount of money that we've paid out to recover from the GFC crisis. It's just staggering numbers. And we need, you know, the NAB monthly business survey came out scathing of the government to say, hang on guys, you've got a responsibility here to turn this economy around, and you can't do it by, you know, approaching it with a feather. You need a sledgehammer to the bloody place and get stuck into it. Now, their forecast of 6% renewal in the GDP, in the recovery, is close to fanciful, to be frank. And we're all intelligent people, and I think people will see through a lot of this stuff. Let's just go to, and I am to, over the next 8 weeks, going to be breaking this all down to what it actually, how it impacts small to medium enterprise. And remember, the SME sector in this country makes up 99% of the economy, employs 95% of all employees in this country. You know, mum and dad businesses, SMEs, people who are trying to get out there and grow, who are watching this today, are the ones that have got the backbone of this country. And what do we give them? More confusion, less clarity. That's great. Anyway, I'll get off my soapbox in a moment, but before I do, I just want to make the point that if anyone watching today thinks that all is going to be hunky-dory in 18 months' time, they're kidding themselves. We're going to be a 5-year program to get back to normal. And I think I'm optimistic. And I'm a guy now who does believe in optimism, because I want to drive that, help drive business growth through the other side of this recovery, even though we are heading well towards a depression. You've got a 7% contraction of the overall GDP, and we fight it with a 6% recovery. I'm no great mathematician, but we're still going backwards. Anyway, thanks, Sam, for having me. My point is 5 years of recovery minimum. You need to plan for that today. You need a business health check. You need to make sure that you're okay. You need to be getting in touch with the fantastic leadership group you've got here and making sure you're in touch with how you're going to come out of this the other side.
Indeed, and thank you, Adam. Great word of wisdom there, and you know, a lot of planning does need to be done. You know, if it's going to take 5 years for us to get back to normal, something I'll touch base on as well in my little section also. Let's throw to Lisa Garrido, and Lisa, can you tell us a bit about the impact of the budget and I guess HR and employment?
Yep, here we go. Thanks, Sam. So as everybody's aware, Josh Frydenberg announced a suite of changes that will significantly impact employers. And these include new measures relating to training and apprenticeships through subsidies for youth employment, mental health, and female workforce participation. The aim really of the announcement and the budget, obviously, is to rebuild the economy by creating jobs, but primarily to support nearly 500,000 young Australians at work. So the record investment in the budget is in skills training to strengthen the young Australian workforce. So I'll give a bit of the summary of the changes, and then I will go through some of them individually over the next few weeks. So the summary is job maker hiring credits for employers who hire young workers. The next point is expanded training subsidies for employers hiring apprentices and trainees. And the last major change is new cadetships and apprenticeships for women to increase female workforce participation. Today, I'd like to touch majorly on the job maker hiring credit. So the coalition has announced it will pay organizations to hire young Australians as part of the $4 billion budget measure. It's obviously an incentive to businesses that will hire young Australians and therefore opening new pathways and upskilling them. So the government is ensuring that the next generation of workers won't be left behind in this economy or in an economy reeling from the pandemic. So the subsidy known as Job Maker means that the employers will receive a credit for each new job if they create or hire someone between 16 and 35 years old. Again, I repeat, 16 and 35 years old. So a credit of $200 per week for 16 to 29-year-olds and $100 per week for 30 to 35-year-olds. It will be available until this time next year. Really, it's payable with, for a period of up to 12 months. Apart from the major banks, all businesses are eligible for this new scheme, but to qualify, new employees are required to render 20 hours of work per week. So a few weeks ago, I talked about the Fair Work flexibilities, so that minimum 20 hours, that will remain the same. The new employees must also have received a job seeker payment, a youth allowance or parenting payment for at least 1 month out of the 3 months prior to being hired. So again, that is a summary of Job Maker. What about for training and apprenticeships? What does the budget say about that? The plan is to expand the training and upskilling programs by the government pledging to cover half the wages of 100,000 new apprenticeships and traineeships. So it is capped to 100,000 new employees. So the plan is to cover 50% by way of wage subsidy, and it'll cost the government about $1.2 billion over 4 years. So again, that is a wage subsidy to support school leavers and workers who have been displaced by COVID-19. And these two initiatives I've just spoken about is their move to replace JobKeeper wage subsidy and job seeker payments. So that's for the training and apprenticeships. What about the mental health initiatives? As everybody knows, we have been impacted. There's been a major toll on our mental health through COVID-19, and the government has announced the extension of a few key services, one of which the number of Medicare-funded psychological services will be doubled from 10 to 20. So there will be more announcements on that, which I'm hoping to share with you all in the weeks to come. And with regards to female workforce participation, apparently the statistics have said that since the easing back of health restrictions, the jobs and with the jobs having come back, 60% of the 458,000 jobs created have been filled by women. So that's a really positive move. But with regards to female workforce participation, the budget includes the government's second Women's Economic Security Statement with $240 million in measures to support new cadetships and apprenticeships for women in science, technology, engineering, and mathematics, job creation for women and encouraging women entrepreneurs, and women's safety at work and at home. So those are basically the initiatives stipulated in the budget. Next week, I'd really like to talk a little bit more about this, particularly the impact of employers who have employees that are clearly over 35 years old. So what happens, and how does the budget actually help us there? So I will leave it at that, and over to you, Sam.
Fantastic, and thank you, Lisa. I love the content-rich information that you provide to our viewers every week, and that's going to help them better shape their businesses and be able to do what they do much better. So thank you very much for that, and indeed, thank you to all the panel members for their feedback and advice over time. Let's have a chat with Rob. Welcome back, Rob, and tell us what's happened to the property market since you've been gone.
Thanks, Sammy. Well, since I've been gone, numbers from last Saturday, the 10th of October 2020, the spring market was in full swing. 719 homes going to the gavel. If you remember back, I think a month ago, they were hovering around 500, so up well over 200 properties. Final clearance rate for the day was 70% clearance rate, so a very, very strong market. 7 out of 10 homes selling at auction. If you look at this time last year, the clearance rates were at 74%. Total sales volume for the week, just over 357 million. I'm sure the state government will be happy with all that stamp duty tax money coming into their coffers. Well needed, I'm sure. School holidays are finished today, as we all know. I'm very happy about that. The kids weren't, but I was very happy. Now, you may be thinking about where to go at the end of 2020 and the start of the 2021 holidays. You need to start thinking about where you want to go. Now, if you recall back, I think episode 3 of Business Insights, I said to our viewers then, book something, book it in today, because by the end of the year, things will be fully booked out and prices will be a lot higher. Now, if you hadn't done that, it's too late. I inquired about a place that we like to go to last week, which is the NRMA Tourist Park. It's actually a caravan park, but it sounds better saying tourist park. Up in Umina Beach. It's a great place for young children. Anyway, 1 month ago, it was $265 a night during peak season, which is January 2021. As of last week, it's gone up to $570 a night. And there was one place left. Totally, almost booked out. So you're a bit late, but however, my advice is today, it's changed. I've had a good think about it. With the border restrictions easing, I would say hold off, because we'll be allowed to travel soon. And I think it'll give us a lot more options, and I believe prices will come down. So hold off on booking anything now and wait. Property negotiation tip of the week. With auction clearance rates being so high, my advice is to buyers at the moment is put a pre-auction offer in. Don't go to auction. Put a pre-auction offer in. Try and take all the competition and the emotion that comes out of auction day. As you know, the more people go back to a home, once they've spent money financially and they've psychologically made a decision to buy it on the day, if they're there at auction and it's reached their reserve, 9 times out of 10, they're going to dig a little bit deeper, right? That emotion kicks in. So put a pre-auction offer in. If you're unsuccessful with the pre-auction offer, at least you get another bite of the apple, because you can go on auction day and have another crack at it, right? Gives you 2 bites of the apple. That's my tip of the week. And if you need anything property-wise, please feel free to reach out, give me a call. That's it from me. Thanks, guys.
Fantastic, and thank you very much, Rob, for your fantastic update about property and where to go or where not to go for holidays. A very famous place that our previous Prime Minister used to go to was Hawke's Nest, and that certainly is a place that is nice and quiet to go to. But I'm sure it will be hard to get a place there as well. Okay, so on to myself, and I'll cover off on the interest rates in the markets. So interest rates continue to hold steady at the moment, with owner-occupier fixed rates in the low 2% and variables in the mid 2%. Investment fixed and variable rates are sitting slightly higher than that in the mid 2s and going upwards. Now, just recently, the government came out as part of the Reserve Bank announcements in particular and said that they are committed in keeping the rates low for longer at this point in time, and they'll use different mechanisms to continue to have that occur. So if there are any changes to that, obviously I'll provide some update to you guys on this forum. But the big news really around interest rates is about the fact that the government announced that they are going to loosen the regulation around lending. So from a few years ago, the common sense started to go out of the way that the banks were looking at doing the lending, and this was having major impacts on service levels, people being able to borrow money, or in fact even just be able to make the transactions completed. So this common sense prevalence is going to be very good. It's not law as yet, but it's definitely in motion and should help many borrowers being able to transact better, or in fact even look at getting out of some of their loans that they've been stuck in with higher interest rates because of this government regulations that was put in place. It will take a little while for it to work through ASIC, and ASIC will need to give those guidance to the banks along with APRA. And again, I will update you as we see that flowing through to the banks and the policies that they have. Onto the markets. Markets had a very good week last week on the back of the budget and the overall resilience shown in the overseas market. ASX in fact had a very good week. ASX rose by 5.5%. It was buoyed by the energy sector, also buoyed by the financial stocks. Stocks in finances, banks in particular, went up about 7.8%. This was on the back of the announcement about the government's loosening of the regulations. And of course, the infotech continues to go up. It went up by about 7.8% last week. Focus will now be on that post-US election, not so much as at the actual election, but post-US election, and of course, approval of the budget in the parliament. And again, these are the main catalysts that we're going to be keeping an eye on at this point in time, and not to mention any vaccines for COVID-19. Now, of course, with the budget, the government has gone on a massive spending spree, and the impact of that should flow through soon enough through the economy. It is expected that the deficit for the budget will peak at almost $1 trillion by the end of the decade. That's a huge number. Eventually, it would have to be paid off. Some of it may be through just the fact that there's inflation, but the rest of it will have to be done. And who knows? At one point, we may even see organisations like Australia Post being privatised. We may not see normal, just as Adam said, until a little bit later. So I think the budget said at least till 2024. And so 4 to 5 years seems to be the period that we're going to get back to some normality. And of course, we still need to be cautious because these loan deferrals that are coming off, and we'll have to see the impact of that. The JobKeeper waning, we'll have to see the impact of that. And there's a lag in those impacts that's going to flow through probably in the first half of 2021. And of course, no doubt Victoria's lockdown has weighed on the country quite a bit, and in particular on the psyche of the Victorians. And certainly our thoughts are here at Business Insights do go out to all those people in Victoria who, amongst many things, won't have their AFL Grand Final in their estate this year. So, so it's a travesty for them. So some key aspects of the budget that is useful to just touch base on. Housing and construction will get a boost of about $14 billion, which is great. First-time owners will benefit from that. Retirees will get a further $250 in December and March. Disappointingly, there was nothing specific about self-funded retirees in the budget. But as Ian mentioned before, with the lowering of the taxes, most people will get somewhere in the vicinity of 1.5 to 2.5% more cash in their hands. So if you're on 100K, you'll end up with about $1,500 more in your pocket going forward, which is good. And of course, if you want more information on those budgets, we've done a blog on that, and you can find that on moneyclick.com.au. Now, that completes our webinar section of the updates. I'm going to now throw it to the panel and see if there's any questions that we need to address or any comments.
Yeah, I had a question that came up on my Facebook feed for Lisa, and maybe it's something we can talk about next week, is the impact. Statistically, the mental health sector gets smashed from people that are above the ages of 35. And of course, they've been completely left out of this budget moving forward. And I guess that's what the question is how, what's the government going to be doing? Are there any softenings of that? And can we expand on that for next week?
Absolutely, I can do that. So far, there's still going to be some initiatives that the government is going to be announcing when it comes to mental health programs. But if, for some of individuals who aren't aware, as you know, you get 10 sessions with your psychologist or therapist, as long as it is approved within the mental health regime. And you get Medicare funded appointments. That's now doubled. So I think that is quite significant. Although I feel that, and I will look into this to see whether or not some of the employee assistance programs can be subsidized as well. But that's something that I'm hoping we can get some kind of clarity on, because from a workforce perspective, it's really the employee assistance programs that makes a huge difference to employees. Yep.
I think my solution is that I'm just going to start identifying myself as a 33-year-old male.
What did they say? How do the Australians say it? In your dreams, No, next, the announcements in terms of assisting the youth actually regain and upskill and regain some traction in their employment, I think is a massive initiative. But of course, the opposition is talking a lot about what about anybody above 35? And how does that help? So there's a lot of information that's coming out, and it comes out, and I get updated daily. So what I want to do next week is just touch on some of that, because these are controversial topics. And I think it'll really be good, particularly for businesses that have the older workforce, as I do in my business. How do we get some assistance from that? And maybe it's the tax breaks, who knows? But more next week and in the weeks to come.
Adam, I thought I read somewhere that the budget has about $5.7 billion put towards mental health and suicide prevention in the coming year. And obviously part of that is going to go out and pay for what Lisa just mentioned before in terms of doubling the Medicare rebated visits to 20. So,
yeah, that's right, Sam, and I think that's great, but it's about only 10% of what's actually needed, in my humble opinion. But it's a step in the right direction. It just shows you how little is provided out there.
Yeah, absolutely.
Rob Skeen, you look like, how I've just spent 2 days in the sun running around refereeing rugby sevens, and I come out nice and dark and a nice tan complexion. You go away on holidays and your hair goes whiter.
I know what's doing. I think it's the hair dye I'm using. It's supposed to be blonde. Quick one for you, Sam. I hear that there's rumours of the banks easing their lending next year. Is that true?
Yeah. So that's so basically that's the announcement made by Judge Frydenberg that they're going to give specific instructions to ASIC to basically come up with some new guidelines that's going to make it easier. Essentially, what they've said is, look, they went too far one way, and they've finally recognised the fact that one size does not fit all, and not everyone has Wagyu beef and wine, expensive wine every night. And so look, common sense is actually prevailed, which is going to be good. And that would definitely help. Obviously, the fact that we have this lower interest rate environment, if someone is employed and their employment is secure, that's definitely going to help them in having the certainty to be able to go forward and make property transactions. But as it stands right now, obviously, it's really helping people.
Sam, is there a way, maybe at some point in the next few weeks, you can talk about the self-employed and how that impacts the self-employed more than, because a lot of our audience are business owners, and that would really tie in as well to trying to encourage women to become entrepreneurs as well, in terms of what can women do to do that. So
yeah, absolutely.
Ian, I've got a question for you. With the income tax cuts, what sort of salary bandwidth is benefiting the most from this? Is it the 75 to 100K bandwidth, or where's the most impact?
Well, the most impact is, what I mentioned in my piece was that a lot of business owners will generally pay themselves out of the company a salary of 90,000 because it's generally taxed at around about the same tax rate as the company tax rate. But now they're increasing that to 120,000. So there's really an extra $30,000 there that the business owner can get out per year. And if there's two of them, it's an extra $60,000. So that's the major one for me. There obviously also is that smaller part as well, where it raises from 37 to 45 in that 19% income tax bracket. But one thing to note is that these changes take effect from 1 July 2020. So what does that mean? Does that mean that is there a whole bunch of backdating going on? No, based on because they would have paid more tax than what they should have. So there's some really interesting pieces there for business tax planning as well. Yeah, I mean, I'm going to be doing that with most of my clients, sitting down and looking at the salaries that we've been paying to the owners, and then how can we increase those to best take advantage of these cuts?
Thank you. Looking forward to the next coming weeks with a lot of the extrapolation of all of these.
Yeah, there certainly is some benefits. And just one last question for you, Ian, perhaps. Obviously, with the cuts to the tax rates, potentially other structures will be less relevant for some people, setting up companies and a family trust, etc., to distribute income for tax efficiency. Obviously, asset protection is a different story, but would I be correct? I think we just lost Ian, so we'll see if he comes back.
Yeah, oh no, there he is. He's coming back.
Yeah, you're back, Ian. Did you catch what we said?
Yeah, I'm back. Yeah, no, I heard the question. Thanks, Sam. Sorry about that. So, the business, as you mentioned, will generally be set up either as a trust or a company. And in a lot of those, in my case, with a lot of my clients, we, regardless of the setup, we will sometimes pay the owners a salary out of there. So not really much difference between a trust or a company. There was no changes to distribution or anything like that. But if you did have a trust where you did not pay any wages out of the trust during the year, then obviously we can distribute more at a lower tax rate, the $45,000 range. And then if we distribute more than that, say from the $90,000 to $120,000 level, then when that money finally hits the beneficiary's tax return, they are going to be paying less tax. So there's also an argument there, Sam, for those beneficiaries. If they pay quarterly pay-as-you-go installments during the year, now we can look at maybe varying some of those installments down because the amount of tax payable at the end of the year based on those distributions isn't going to be as much.
Yeah. Okay. Fantastic. Thank you very much, Ian. Okay. Well, that completes our session for this week. Make sure you check us out on Facebook and YouTube. And to close off, I thought I would close off with a nice little quote that I'm sure you would have heard many times before. God grant me the serenity to accept the things I cannot change, courage to change the things I can, and of course, have the wisdom to know the difference. So let's all concentrate on everything that we can change so we can rebuild back to normality sooner. With that, we're signing off from Business Insights and see you next week.